Hello friends, welcome to Ria's classes. So we are now beginning chapter 3 recording of transactions. So in the earlier chapters we understood what accounting is, why accounting is important and the basic accounting concepts that guide the recording of business transactions. But now we are moving into the practical stage of accounting. Until now we were discussing only theory, but from this chapter onwards we'll begin learning how the accounting is actually done in real life. So accounting is not just about preparing final accounts or calculating profit. It is a process, and this process begins with identifying a transaction. If there's no transaction, there's nothing to we have nothing to record. So the very first step in accounting is to understand what a transaction is. Now let us see the learning objectives of this chapter. So basically this learning objective, it tells us what we are going to study in this. Okay, so after studying this chapter, we'll be able to describe the nature of transactions as well as the source of documents. Okay, so that means we must clearly understand what qualifies as a business transaction and what does not. Okay, so not every event in the business is a transaction. For example, if you're planning to buy goods, hello, then it is not a transaction. If we are negotiating a price, it is not a transaction. So a transaction basically happens only when there is an actual exchange of economic value and it can be measured in monetary terms. So this is our first objective. Our second objective is to explain the preparation of accounting vouchers. So that means that we must learn how the transactions are documented. So accounting basically does not work on assumptions or memory. It works on evidence. So every entry it must have a proof, and this proof is called as a voucher or a source document. Now let us see the third objective. The third objective is to apply these accounting equation to explain the effect of transactions. Okay, so accounting equation which we studied earlier is basically assets equal to liabilities plus capital. So every transaction must keep this equation balanced. So this is the basically foundation of double entry system. The fourth objective is to record the transaction using the rules of debit and credit. So debit and credit, they are not just terms, they are basically the method through which we record the transactions. So we must understand what to debit and what to credit and why. The fifth objective is to explain the concept of the book of original entry and recording the transactions in journal. So journal is basically the first formal book where the transactions are recorded. And finally, we'll understand the concept of ledger and posting of journal entries to the ledger accounts. Okay, so this chapter basically lays down the foundation for the entire accounting system. Hello, now let us move towards the business transactions and source documents. Okay, so to understand a business transaction, so the book basically gives us a very simple example. Suppose after securing good marks in your examination, your father promises you to buy a computer. Okay, you go to the market with your father and you purchase a computer for rupees 35,000 in cash. So the dealer will gives you a cash memo and your father makes the payment. Okay. So now let us analyze this example very carefully. What happened here? Basically, two things happened at the same time. First of all, cash was given and the computer was received. So this is basically exchange. So what is happening here? One party gives something. What are we giving? We are giving cash, and this party is receiving something in return. What we are receiving? Computer. So this is basically called as a reciprocal exchange. So this idea of give and take is the foundation of accounting. So every business transaction basically involves two aspects: a give aspect as well as a take aspect. So in this example, the aspect is the payment and the take aspect is receiving the computer. So because there are two aspects, at least two accounts are affected. Hello. Now, for example, if an employee is very hardworking, that cannot be recorded in accounts because it cannot be measured in money. If a manager is inefficient, that cannot be recorded either. But if salary of rupees 20,000 is paid to an employee, that is measurable in money and therefore it is recorded. So, for an event to qualify as a transaction, basically three conditions must be satisfied. First of all, there must be at least two parties. Second, there must be an exchange of value. Third, the transaction must be measurable in monetary terms. So, our text further explains that the business transactions are usually evidenced by appropriate documents. Okay, so it has given us some examples such as cash memo, invoice, sales bill, pay slip, check, salary slip, etc. So these documents, what are they called? They are called as the source documents or they are called as the voucher. Now let us see why are these documents important. Because we know accounting, accounting must be reliable as well as verifiable. So every entry which is recorded in the books, it must have proof. So suppose the accountant records that rupees 50,000 was paid for furniture. So if there is no bill or if there is no voucher, then how will the auditor verify this payment? So that is why documentation is extremely important. So a source document is basically it is the written evidence of a transaction. So it proves that the transaction has actually occurred. It contains the details such as date, the amount, the name of parties involved, and the nature of transactions. So sometimes there may be no external document available. For example, small petty expenses like tea or postage, it may not have any formal invoices. So in such a case, the business prepares an internal voucher and this voucher is approved by an authorized person within the firm. So even if the expense is small, it must be documented. So all vouchers are basically arranged in a chronological order. What is the meaning of chronological order? Means date wise we are maintaining. They are serially numbered, like for 1st April, 2nd April, 3rd, 4th, 5th, like that. And they are kept in separate files. So this basically ensures proper control as well as easy verification. So during audit or tax assessment, what is done? These vouchers, they are examined. So therefore they must be preserved until audit and tax processes are completed. Okay. So here we have seen a specimen of the transaction voucher. So voucher generally contains, we know the name of the firm at top. It has a voucher number for serial control. It mentions the date of transaction. It specifies when the which account is debited, which account is credited. It shows the amount which is involved It contains a narration also, which is, what is this narration? Is a brief explanation of the transaction. It also contains signature of the authorized person who has prepared the voucher, and the person, this is prepared by whom and authorized by whom. So each of these details is important. The voucher number basically ensures that no voucher is missing. The debit and credit accounts ensure correct classification. And what is this narration for? It basically helps in understanding the nature of transaction after, even after several years. Signature, what is the signature for? The signature is for accountability. Hello. So now we'll move towards the preparation of accounting voucher. Okay, preparation of accounting voucher. So accounting vouchers, it may be basically classified as cash voucher, debit voucher, credit voucher, or journal voucher. So there is no fixed format for vouchers. The design basically depends upon the nature as well as convenience of business. So let us understand simple as well as compound transactions. Okay. Now, if a transaction with one debit and one credit is called as a simple transaction. For example, if the goods are purchased for cash, then purchase account is debited and cash account is credited. We'll study in the further chapters why this is debited, why this is credited. We are just going through the theory right now. Okay. So only two accounts are involved in this. So this is basically a simple transaction. But sometimes a transaction involves more than two accounts. For example, machinery purchased for rupees 1,25,000, 10,000 is paid in cash and the balance is payable later. So in this case, basically, we have purchased machinery for rupees 1,25,000. Machinery is for 1,25,000. Cash paid is 10,000. In balance, it is basically payable later. So in this, basically, machinery account is debited by 1,25,000. What is credited to cash? Rupees 10,000, and to our creditors, the balance amount 1,15,000. So here basically three accounts are involved. So such a transaction is called as compound transaction. If multiple debits and credits are involved, it's called as a complex transaction, and the voucher prepared is called as a journal voucher. So the design of voucher may vary, we know, but these certain essential elements must always be present. It must be written clearly, it must be written clearly, it must contain the firm's name, it must have the correct transaction date, as well as it must carry a serial number, mention debit and credit accounts, it must state the amount, it must provide the duration, as it must, and it must also contain proper signatures. So to summarize what we have studied till now, accounting basically begins with identifying business transactions. Only those events which involve exchange of economic value and they are measurable in money are recorded. Every transaction has two aspects: give and take. Every transaction must be supported by documentary evidence, which is called as the source document or voucher. The vouchers, they are prepared carefully, they must be numbered serially and must be preserved properly. So transactions may be simple or they may be compound depending on the number of accounts involved. Hello. We now continue further into the discussion of accounting vouchers, and let's move towards one of the most important foundations of accounting, which is the accounting equation. So after understanding simple and compound transactions, we'll now look at the transactions involving multiple debits as well as multiple credits, which are called as complex transactions. So the accounting voucher prepared for such transactions is called as complex voucher, or we can say that call it journal voucher. So let us understand this carefully. In a simple transaction, we know only two accounts are affected. One is debit and the other is credit. But in a compound transaction, more than two accounts may be involved, but generally either one debit and one debit or one debit and multiple credits, or multiple debits and one credit. So however, in a complex transaction there may be multiple debits account, and there may be multiple credit accounts simultaneously. Now suppose, for example, a salary of rupees 50,000 is distributed among departments, and part of it is paid in cash while the other part it remains outstanding. So in such case, more than one expense may be debited and more than one liability or asset may be credited. So this is called as complex transactions because several accounts are affected on both sides. So the format of a complex voucher includes name, the name of the firm. We have the voucher number, we have the voucher date, we have the debit accounts here, we have the credit accounts listed separately with their amount as well as with their narration. It also contains the signature of the person who has prepared the voucher and the authorized person who has approved it. So basically, the design of accounting voucher, it depends on the nature, requirement, and convenience of the business. There's a fixed format or compulsory format which is prescribed for all the businesses. Small businesses, they may use simple handwritten vouchers, while large business, they use printed formats, or they may use computer generated vouchers through accounting software. So different types of vouchers are sometimes printed on different colored papers to distinguish them easily. For example, cash vouchers, they may be printed in one color and journal voucher in another color. So basically, this improves internal control and it reduces the risk of errors. Okay. So, however, regardless of the format, every accounting voucher it must contain certain elements. And these elements, why are they important? They are important because it ensures authenticity, it ensures clarity as well as accountability. So, first, the voucher it must be written on a good quality paper. So, these are some of the essential elements. It must be written on a good quality paper. So, why is it? Why should we prefer good quality paper? Because this ensures that it remains preserved for several years, especially for audit and for tax assessment purpose. Second, the name of the firm it must be printed on top. So this basically ensures that the document clearly belongs to a particular business entity. So this follows the business entity concept. It states that the business is separate from its owner. Third, the date of transaction must be mentioned. So it is important to note that the date written on voucher is the date on which the transaction occurred and not the date on which it is recorded. So this ensures correct recording within the proper accounting period. Fourth one we have is the voucher it must have a serial number. Why serial number? Because it ensures that every voucher every voucher is accounted for. If any voucher is missing, then it may indicate error or possible fraud. Fifth is the names of the accounts. It must be the names of the accounts to be debited and credited. It must be mentioned clearly. Why? Because it ensures correct classification of transactions. Then we have the debit and credit amount must be written in figures against the amount, because accuracy in recording the amounts, it is critical. Accuracy is critical in accounting. Seventh is the narration. It must be given. Narration is a brief explanation of the transaction. So even years later, if someone examines the books, the narration helps them understand the nature of transaction. Eighth one we have is the voucher must be signed by the person who prepared it, because this ensures responsibility, and it must also be signed by the person who authorized it, because this establishes approval as well as control. So these elements basically together ensure that the accounting records, they are reliable as well as they are verifiable. Now we'll move towards a very important section which is called as the accounting equation. Okay, so the books always states that the accounting equation signifies that the assets of a business are always equal to the total of its liabilities as well as capital. So this equation is written as assets equal to liabilities plus capital. Now this is basically the foundation. It is the foundation of double entry accounting. Let us understand this deeply. Assets are basically the resources owned by the businesses. Owned by business. These include cash, it includes bank balance, it includes furniture, it includes machinery, it includes stock, it includes debtors. So assets basically, they provide the future economic benefits to the business. Liabilities, on the other hand, they are the obligation of business. So these are the amounts the business owes to the outsiders. For example, we have creditors, we have loans, we have outstanding expenses. Hello. Next, we'll understand the term capital. So, capital basically it represents the owner's claim on business. So, it is the amount which is invested by the owner, amount invested by the owner plus the accumulated profits minus losses minus drawings. Now ask yourself a logical question. If the business has assets, then from where did these assets come from? So there are only two possible sources. Either the owner has provided the resources or the outsider has provided the resources. If the outsider provides the resources, then it is called as liability. And if the owner has provided the resources, then it is called as capital. Therefore, the total assets, it must always equal to the total claims. So claims includes both the liabilities as well as capital. So that is why asset equal to liability plus capital. So this equation is also called as the balance sheet equation. It's called as the balance sheet equation because The balance sheet is prepared based on this relationship. So the left side of the balance sheet, it shows the assets, and the right side shows the liabilities as well as the capital. So both sides must always be equal. So now let us see further. We also have a derivative forms of the equation, such as asset minus liability equal to capital. We are just taking this, we had written this, so basically we are taking this liability to left side. So asset minus liability equal to capital. We can also write asset minus capital equal to liabilities. So these forms are basically useful when we have to calculate missing figures in question. Now let us look at this example given in book. Okay. So Rohit here basically has started a business with rupees 5 lakh. So from an accounting perspective, this means that the business now has cash worth rupees 5 lakh. So this is basically an asset. Okay. And at the same time, the business owes rupees 5 lakh to Rohit. Who is Rohit? He is the owner. So this is called as the capital. So on the balance sheet, it would show on the liability side, the capital would be, which the owner has brought, the capital would be 5 lakh rupees, and the asset that we are having cash in hand would be rupees 5 lakh. So basically, the liability side is matching with the asset side. Both the sides are balancing. Now let us observe something important. At this stage, basically, the business has not yet earned any profit, or it has not suffered any loss. So therefore the capital, it will remain 5 lakh rupees only. Now if suppose the later on the business earns profit, then what will happen? This 5 lakh rupees, this capital will increase, and if the business suffers loss, then this capital, it will decrease. So this shows that the capital is dynamic. Okay, so it changes with the profit and loss. Now we'll analyze the transactions to show how the accounting equation remains balanced even after each transaction. Okay, so the first transaction is, we have opened a bank account in State Bank of India with an amount of rupees 4 lakh 80,000. Let us look at the analysis. So what is happening? This just means that the cash has decreased by rupees 4 lakh 80,000. Okay, whereas our bank balance, it has increased by rupees 4 lakh 80,000. So we know both cash as well as bank, they are assets. Okay, so cash and bank, these are asset sides. So cash, we know it has decreased, whereas the bank balance, it has increased. So one asset decreases and the other asset increases. So therefore the net effect is that the total assets will remain unchanged. So liabilities and capital, we know it's already remaining unchanged, so therefore the equation remains balanced. Next is that we have bought a furniture of rupees 60,000 and check was issued on the same day. So in this, basically, the furniture, it increases. We have bought furniture, so what will happen on the asset side? The furniture, it will increase by rupees 60,000, whereas our, since check was issued, so our bank, it would decrease by 60,000. Okay, bank, we had 60,000, so it will become zero basically. So once again, the one asset increases and the other asset decreases. So basically, the total assets, it remains the same. Once again, the equation remains balanced. Third we have is, we bought a plant and machinery for the business for rupees 1,25,000 and an advance of rupees 10,000 is paid to Messrs. Ramji Lal. So the third transaction is in this, we are purchasing plant and machinery for 1,25,000 with 1,25,000 with 10,000 we have already paid. So how much amount is left to pay? we have 1,15,000 which is payable later. So here what is happening? A plant and machinery, it increases by 1,25,000. The cash that we were having, it decreases by 10,000, and the liabilities will increase by 1,15,000 because the payment is pending. Now let us calculate the net effect. Okay. The assets increased by 1,25,000 due to machinery, but the asset decreased by 10,000 due to cash payment. So the net increase in assets is 1,15,000, whereas the liabilities, it increased by 1,15,000. Capital, we know it remains unchanged, so thus the both sides increase equally. So the equation once again remains balanced. So this clearly shows that every transaction, no matter how complex, it keeps the accounting equation balanced. Hello. So up to this point, we have analyzed transactions using the accounting equation. We saw how every transaction affects the assets as well as the liabilities or capital, and how the equation always remains balanced. But in the actual accounting practice, we do not prepare an accounting equation table for every transaction. So instead, we use a systematic method called as double entry system, which is based on debit as well as credit. So in double entry accounting, basically every transaction affects and is recorded in at least two accounts. So when recording each transaction, the total amount debited must be equal to the total amount credited. This is not optional, this is the fundamental rule of double entry accounting. So now let us understand what debit and credit actually means. Okay. So debit does not mean loss, and credit does not mean profit. So basically, debit does not automatically mean increase, and credit does not automatically means decrease. Debit simply refers to the left side of an account, and credit refers to the right side of an account. To understand this clearly, the book introduces the format of an account, commonly referred to as the T account. We can see this. So this account is represented in the shape of the letter T. So at the top we write the name of the account. The left side is called as the debit side and the right side is called as the credit side and is abbreviated as CR and this as DR. So whenever transaction affects an account, the effect is recorded. We record it on the either on the debit side or on the credit side. For example, consider cash account. When cash is received, we record it on the debit side. Okay. And when the cash is paid, we record it on the credit side of cash account. So at the end of the period, the difference between the total debit and the total credit of the account is recorded, and this difference basically gives us the balance of cash. So if the debit side is greater than the credit side, then cash account shows a debit balance, and if the credit side is greater than the debit side, then cash account shows a the cash account the whatever account is, it will show a credit balance. Now the accounts can basically be classified into five categories. Understanding the rules of debit and credit, these five categories are assets, liabilities, capital, expense or losses, revenue or gains. Now let us discuss each category in detail and understand the rules logically. First thing we have is assets. Okay, assets will write. So assets, what are they? They are basically the resources which is owned by the business and it provides future economic benefit. For example, cash, bank balance, furniture, machinery, stock, land, building, and debtors. So the rule for assets is simple. An increase in asset is debited and a decrease in asset is credited. Let us understand why. For example, when if a furniture is purchased for rupees 10,000 in cash, then furniture increases. Furniture increases, so we debit the furniture account. But cash decreases, so cash account we will credit. Second we have is expenses. Expenses are basically the cost which is incurred in the process of earning revenue. For example, we have salary, we have rent, we have electricity, we have insurance, we have telephone charges. So the rule for expense is that an increase in expense is debited and the decrease in expense is credited. Okay, increase in expenses debited, decrease in expenses credited. So why do we debit expense? Because what is happening is expenses they reduce capital, and since capital has a credit balance normally, so any reduction in capital must be recorded on the debit side. So therefore the expenses are debited. For example, if rent of rupees 5,000 is paid in cash, then rent account will increase, so we will debit the rent account. We'll debit the rent account, and cash account decreases, so we will credit the cash account. Hello. Third, we have the liabilities. Liabilities. So liabilities are basically the obligations of the business towards outsiders. Example includes we have creditors, we have loans, we have bank overdraft, as well as we have outstanding expenses. So liabilities normally have a credit balance. That is, the total of credit is greater than the debit side. Okay. So the rule for liabilities is that an increase in liability is credited and a decrease in liability is debited. Okay. So when liability decrease, we record it on the decrease on the debit side, and when it increases, we record it on the credit side. For example, if goods are purchased on credit for rupees 50,000, we know the liabilities, the creditors will increase. So we credit the creditor account. What is creditor basically? It's an outside liability. We have to pay the creditor. We have not paid cash, so we have to pay the creditor. So what will happen? Creditor account, since liability is increasing, so we'll write it on the credit side. And if later on we pay to the creditor, then the liability will decrease. So we'll write to cash, the liability will decrease. We'll write it in here. Okay, so we debit the creditor account, and since we are paying, this liability has decreased when we have paid, and cash account we will credit when we paid because asset is decreasing. Hello. Fourth, we have the capital. Okay, capital. So capital basically represents the owner's claim on the business. So it is the amount basically which is invested by the owner plus the accumulated profits. So the rule for capital is that an increase in capital is credited decrease in capital is debited. Okay. So if the owner introduces additional capital, then the capital will increase and we'll credit capital account. And if the owner withdraws, so what is happening basically when we're withdrawing? The capital is reducing. So if the owner withdraws money for any personal use, then capital decreases. So in practice, we debit drawings account. Drawings account is debited, which ultimately reduces the capital. Fifth, we have the revenue or gains. So revenue, what is revenue? It is basically the income which is earned from normal business operations, such as it can be sales, it can be commission received, it can be interest received, it can be discount received. So the rule for revenue is that an increase in revenue is credited and a decrease in revenue is debited. So why is revenue credited? Revenue is credited because revenue increases the capital. Since capital increases on the credit side, so revenue is also credited. For example, if goods are sold for cash rupees 20,000, so what will happen? Cash account is an asset. So whenever an asset is increasing, what will happen? It will be recorded on the debit side. So we'll write to sales 20,000. Okay. We'll debit the cash account. Sales, when sales account also increases, we'll credit the sales account. Now let us connect all these rules with the accounting equation. We know the accounting equation. We have assets equal to liabilities plus capital. So assets normally have debit balance. Liabilities and capital normally have credit balance. Expenses, we know expenses, they reduce capital, so they are debited. Revenue, they increase capital, so they are credited. So thus the rules of debit and credit, they are not random. They are directly derived from this accounting equation. Now let us summarize these rules into a chart. Let's look at this. Asset, okay, increase in asset, debit, decrease in asset, credit. Talking about liabilities, capital and revenue, increase, increase in liability, revenue, it will be recorded on credit, and decrease in capital, liability as well as revenue, debit. Expenses, if it increases debit, if it decreases credit. So this summary must not be memorized blindly, it must be understood logically. So if you have understood that the assets are on the left side of the equation, liabilities and capital are on the right side, everything will become simple. Now let us apply these rules through a few examples. If salary paid, if you have paid salary 8,000 rupees in cash, so what will happen? We know salary, it's an expense. So whenever an expense is increasing, what will happen? It will be debited. So salary account, it will be debited by rupees 8,000. Okay. And if it's paid in cash, then we will write to cash account. corresponding entry would be in cash account. We know when we are paying the salary, our cash is reducing. When the asset is reduced, when it decreases, we will credit cash account. So we'll write here to salary rupees 8,000. So for every debit, there is a credit. Hello. Next example is if commission of rupees 3,000 is received in cash. So cash will increase. So we are receiving, hello, we'll debit cash account by rupees 3,000. Cash is an asset, and whenever an asset increases, it will be debited. And commission, it is an income. Commission is an income. So whenever incomes increase, we write it on the credit side to cash commission account. So if the owner withdraws, next example is if the owner withdraws rupees 15,000 for personal use. So whenever we are withdrawing for personal use, it will be called as drawings. Drawings is nothing but reduction in capital. So what will happen? Our drawings account, it will increase. So it will be debited. Drawings is nothing, just the opposite of capital account we are saying. When so in capital, whenever anything is recorded, whenever there's an increase, we credit it. So and in the drawings, whenever anything is increasing, we will debit it because our capital is basically decreasing. So we'll debit here 15,000. Okay, and cash account we'll credit. So in every case, the total of debit is equal to the total of credit. So this equality of debit as well as credit ensures that accounting equation remains balanced at all times. Double entry system is therefore based on two fundamental principles. Every transaction has two aspects. Total debit must be equal to the total credit. If at any time the total debit does not equal to the total credit, then it indicates an error. Hello, let us look at these examples. Rohit started a business with cash of rupees 5 lakh. So basically, what is happening? Cash is increasing. Cash is an asset. Whenever an asset increases, it will be recorded on the debit side. And capital account, it is increasing. Whenever account increases, we record it on the credit side. Okay. Next we have opened a bank account with an amount of rupees 4,80,000. Okay, so we are continuing with this. When we open a bank account, so basically our cash is decreasing. Whenever asset decreases, we'll record it on the credit side. So 4,80,000 will be recorded here. And bank is an asset. When the asset is increasing, we'll record it on the debit side. So 4,80,000 we'll write here. Third is bought furniture for rupees 60,000 and issued cash for the same. So furniture is an asset. Whenever an asset is increasing, it will be recorded on the debit side. And bank is a since we're issuing check, so what is happening? We are paying for it. Our bank balance is reducing. So the bank account reduction in asset will be recorded on the credit side. So we'll record this 60,000 on the credit side. Bought plant and machinery from Ramji Lal for the business for rupees 1,25,000 and an advance of rupees 10,000 is given. So what will happen? Plant and machinery is an asset. So plant and machinery on the debit side, we'll record this amount, and we have paid advance of rupees 10,000. So basically, cash account it will be decreased by rupees 10,000, and increase in liabilities. He is a creditor, Ramji Lal. So Ramji Lal, Ramji Lal is a creditor. Our creditor is a liability. So whenever liability increase, it will be recorded on the credit side. So basically, plant and machinery is 1,25,000. So on debit we have 1,25,000, and on credit we have 10,000 plus 1,15,000 equal to 1,25,000. So basically, the debit here is matching with the credit. Hello. Next, we have goods purchased from Sumit Traders for rupees 55,000. So goods we are purchasing. So we write it in the purchase account. It will be debited by 55,000. And since we are purchasing it on credit, so it will Sumit Traders account is a creditor. Creditor is a liability. Whenever liability increases, we will credit it. Goods costing rupees 25,000 sold to Rajni Enterprises for 35,000. Okay, so sales is our revenue. So whenever it increases, say, then it will be recorded on the credit side. Rajni Enterprises, they are our debtors. Okay, so debtors basically they are owing money to us, and in case of creditors, basically we have to pay them. So debtors are basically assets, creditors are liabilities. Because why they are liabilities? Because you have an obligation to pay them. So Rajni Enterprise here in this case, they are our debtors because we have to receive money. So when the debtors increase, asset is increasing, so we'll record it on the debit side. Hello, we have paid monthly store rent for rupees 2,500 in cash. Rent is an expense. Whenever expense is increasing, it is debited. Cash account, since cash is decreasing, so it will be recorded on the credit side. Paid rupees 5,000 as salary to the office employee. Salary is an expense. When expense is increasing, we'll write it here on the debit side. And cash account, since our cash is decreasing, we'll write on the credit side rupees 5,000. Next, we have received check as full payment from Rajni Enterprises and deposited the same into bank account. So earlier we had recorded this. They were our debtors, and when the debtors had increased, we had recorded this in the earlier entry. Now we have received a check for it, so our debtors is decreasing. So we'll write it on the credit side. Since we have received check, so bank account, our bank balance will increase. So we'll write 35,000 on the debit side. So we will now continue further into the rules of debit and credit and the classification of accounts, which will help us to understand how the journal entries are formed. So up to this point, we have discussed five major categories of accounts. We have assets, we have liabilities, we have capital, we have expenses, as well as we have revenue. Now let us further we'll understand the classification of accounts into three traditional types, which provides another way of understanding the debit and credit rules. So these three types of accounts are, first of all, we have the personal accounts, then we have real accounts, third we have nominal accounts. Now, this classification is very important because traditionally students were taught debit and credit rule based on these three categories. So, let us understand each category carefully. First of all, we have the personal accounts. So, personal accounts, as the name suggests, personal accounts refer to persons. Okay, so a person can be a natural person like Ram, Sham. A person can also be an artificial person. For example, a company, it can be a company or a bank or an institution. For example, State Bank of India. So it's treated as a person in accounting. Similarly, ABC Limited is also treated as a person. So personal accounts can also include representative representative personal accounts. So these are the accounts that represent certain persons indirectly. For example, outstanding salary account represent employees to whom salary is payable. It can also be prepaid rent account. So this represents the landlord to whom the advance rent has been paid. So the rule for personal account is, this is very important: debit the receiver, credit the giver. Now let us understand this with an example. If goods are sold to Ramesh on credit, goods are sold to Ramesh on credit. So Ramesh is basically receiving the goods. So who is the receiver here? We have to debit the receiver. Receiver is Ramesh. So Ramesh account will be debited because he is the receiver. Now, sales account is credited because the business gives the goods. Okay, the business is giving the goods. We'll show it in sales account. So, if payment of rupees 10,000 is made to a creditor, then who is the receiver of cash? Who is receiver of cash? The creditor. Okay, and when we so in creditor's account, creditors receiving cash, so we will debit the creditor because he is receiving the cash. Cash is credited because cash is given, so cash account is credited. So the rule debit the receiver, credit the giver applies to personal accounts. Next we discuss personal accounts. Next we have real accounts. Real accounts basically refers to assets. They include tangible assets like furniture, machinery, cash, goodwill, sorry, not goodwill, cash, building, and it includes intangible assets as well, like goodwill, patents, trademark. So the rule for real account is that debit what comes in, credit what goes out. Let us understand this with an example. For example, if furniture is purchased for cash, then furniture is for cash. What is happening? The furniture is coming. So furniture will be debited. What is going out? You're paying, your cash is reducing, your cash is going out. So cash will be credited. If machinery is sold for cash, then what will happen? Machinery is sold for cash, then cash is coming, so cash will be debited. And if machinery, since it's going out, then it will be, machinery is going out, so it will be credited. So the rule debit what comes in, credit what goes out applies to real account. Hello. Third, we have nominal account. Okay, so let's discuss nominal account. Nominal account, it relates to expenses, losses, income, and gains. So these accounts are basically temporary accounts that are closed at the end of the accounting period. The rule for nominal account is debit all expenses and losses, credit all incomes and gains. For example, if salary is paid, then salary account is debited, because what is salary? Salary is an expense. So we have to debit all the expense. So salary account will be debited. Cash is credited because cash is going out. If commission is received, what is happening? Commission is income. So commission will be credited. And since cash is coming in, so cash will be debited. So nominal account, it is following the simple rule: debit all expenses and losses, credit all incomes and gains. Now, it is very important to understand that the traditional classification of accounts into personal account, personal, real, nominal account is consistent with the modern classification into assets, liabilities, capital, expense, as well as revenue. So both the systems ultimately lead to the debit and credit rules. The difference is only in presentation and method of explanation. Hello. Now let us see how we identify accounts in a transaction. Okay. So whenever transaction is occurring, the first step is to identify the accounts involved in the transaction. Then we will second step is we classify the each account. Then we apply the debit and or credit rule. For example, suppose goods purchased on credit from Mohan for rupees 20,000. So first of all, we'll identify the accounts. We are purchasing, so we'll identify the accounts. We have purchase account, we have Mohan's account. Mohan is basically our creditor. Since the statement is not mentioning that we have purchased on cash, so a creditor is there. Okay, then we will classify it. Okay, purchase account is basically purchase account. It is a nominal account because purchase represents an expense. Mohan's account is a personal account. It is a personal account because Mohan is a person. So apply the rule. Is an expense. So debit all expenses. So purchase will be debited, and Mohan is giver of goods. Then we will credit it. So the entry will become purchase account debit to Mohan account, rupees 20,000. Now let us take another example. We have received we have received rupees 15,000 cash from debtor. Okay, so first of all, our first step is we have to identify the accounts involved. So first account involved is, since we have received cash, so cash account is involved, as well as our debtor is decreasing because we have received so cash from debtor, so a debtor's account is also involved. Now let us classify this. Cash account is a real account, whereas debtor's account is a personal account. So we'll apply the rule. So cash comes in, we'll apply the rule. Cash comes in, so it will be debited. Debtor is giver of cash, so we will credited. So the entry becomes cash account debit rupees 15,000 to debtors account rupees 15,000. Now let us consider an example of salary outstanding. Salary of rupees 5,000 is due but not paid. So let us see let us identify the accounts involved. One we have the salary account, another one we have outstanding salary account. So salary is an expense, so it is a nominal account. It is a nominal account expense. And outstanding salary is this basically a representative personal account. It is a liability because we have to pay this amount. Now we'll apply the rules. We have identified, we have classified. Now we apply the rule. Whenever an expense increases, it will be debited. Whenever the liability increases, it will be credited. So salary account debit rupees 5,000 to outstanding salary account rupees 5,000. Now observe how logical the process is. We have identified the account, we have classified the account, we have applied the debit and credit rules, and then last we'll record the entry. So this is a basically very systematic approach to, and it ensures accuracy. Now we know that every debit must have a corresponding credit. So this is basically the essence of double entry system. Hello. So double entry system, it is called as double not because we are writing any entry twice, but because every transaction has two effects. One account is debited and the other account is credited. So the total of debits must always be equal to the total of debit must always be equal to the total of credit. If one account is debited, then another account is credited. This equality shows arithmetical accuracy. Now let us connect both the classification methods. So modern classification, it says that assets and expenses, when they increase, they are debited. Liabilities, capital and revenue, on the other hand, when they increase, they are credited. So traditional classification says that debit the receiver, credit the giver, debit what comes in, credit what goes out, debit all expenses and losses, credit all incomes and gains. So both approaches lead us to the same journal entry. Understanding both the methods gives us a conceptual clarity. So at this stage, it is extremely important to stop memorizing and start understanding. So if you understand that accounting is based on the accounting equation and every transaction affects at least two elements of that equation, then debit and credit rules will become logical. So assets normally they have a debit balance, norm liabilities normally have a credit balance, expenses they reduce the capital so they are debited, revenues increase the capital so they are credited. Thus debit and credit, they are not some mysterious terms, they are simply structured methods to record the dual effect of transactions. Hello. Now let's move to the next important section, that is books of original entry. So until now we have understood how transactions are analyzed and how the debit and credit rules are applied. But in practical accounting, where do we first record these transactions? The answer is journal. So the journal is basically known as the book of original entry. Why is it said so? Because book of original entry, because transactions are recorded in it for the first time. No transaction directly enters the ledger. Every transaction is first recorded in journal, then it is posted to ledger. So the journal basically acts as a diary diary of business transactions. So just like we maintain a personal diary to record all the daily events, so business also maintains a journal to record all the daily financial transactions in a chronological order. Chronological order means date wise order. So this basically ensures that the transactions are recorded in the sequence in which they occurred. So now let us understand the format of journal. This is the format of journal. A journal basically contains the following columns. It has date, it has particulars, ledger folio, debit, credit amount. So the date column basically records the date of the on which the transaction has occurred. Particulars column is the most important column. It contains the name of accounts to be debited and credited along with narration. The ledger folio column is used later when the entries are posted to the ledger. So this is used for cross referencing. Okay. Debit amount column records the amount of the account that is debited. The credit amount column records the amount of account that is credited. Now let us understand how a journal entry is written. So the journal entry basically it follows a particular format. First, the account to be debited is written on the first line slightly to the left. Here we are writing, for example, cash account. Okay, followed by the word debit. On the next line, slightly indented, we are not writing just below cash. Leave a bit space. Then the account to be credited is written preceded by the word to. So the narration is written below this entry in brackets. Suppose furniture is purchased for rupees. Furniture is purchased for rupees 10,000 for cash. So first we'll identify the accounts. The accounts are, we have furniture account as well as we have cash account. Since the furniture is increasing, furniture is an asset, so it will be debited. So we will write like this: furniture account dr, we'll write, will amount will be rupees 10,000 to cash. Cash is an asset, it is reducing, rupees 10,000. Okay, we'll write in bracket the narration being furniture purchased for cash. So notice that the debit account is written first and the credit account is written below it with the word to. So the word to indicates credit. Now let us take another example. Goods are sold on credit to Ramesh for rupees 20,000. So what are the accounts involved? Since goods are sold to Ramesh, Ramesh basically is our debtor, so Ramesh account, and we have sales account. So Ramesh is the receiver of goods, so we'll debit Ramesh. So Ramesh account debit 20,000 to sales account. Sales is our revenue income. Then we'll 20,000. We'll write here being goods sold on credit to Ramesh. So narration basically explains the transaction briefly. Now let us take another example. Paid salary in cash rupees 10,000. Accounts involved are salary account, we have cash account. We know salary is an expense. Okay, expense. Whenever expense increases, we will debit it. Cash is an asset. Whenever asset decreases, we will credit it. So the journal entry would be salary account debit rupees 10,000, cash account to cash account rupees 10,000, being salary paid in cash. So here also debit account is always written first and the credit account is always written below it. Also, please note that total of debit is also always equal to the total of credit. This is the fundamental principle of double entry bookkeeping system, double entry system. Now let us understand why journal is important. Journal basically journal basically provides a complete record complete record of each transaction in one place. It also shows which accounts are affected. It shows debit and credit clearly. It also provides the narration explaining the nature of transaction. So because of this clarity, journal is considered as the foundation of accounting records. Now we must understand one more important concept, compound journal entry. Okay, so earlier we discussed compound transactions. So compound journal entry is one in which more than two accounts are involved. For example, machinery purchase for rupees 1 lakh 20,000 we have paid in cash and the balance is payable later. So the accounts involved would be machinery account, we have cash account, we have creditor account. So the machinery increases, so it will be debited. Cash decreases, it will be credited. Creditors account increases, it will be credited. So let's see the journal entry. We have purchased the machinery. So the transaction journal entry would be machinery account debit rupees 1 lakh. Cash is decreasing. We have paid cash. Cash account rupees 20,000. Balance is payable to creditors. To creditors account balance amount rupees 80,000. We will write being machinery purchased partly paid in cash and balance payable. So here one debit and two credits are recorded in one entry. So compound entries basically help reduce the number of entries and simplify the recordings. Now let us understand posting. So after recording the transactions in the journal, next we have ledger, which is the principal book of accounts. So journal, we know journal is book of it is book of original entry, whereas ledger it is book of final entry. So posting basically means we are transferring the entries from journal to the respective ledger accounts. For example, In the journal entry, furniture account debited in 1000 when we purchase furniture for cash. Okay, so while posting in furniture account, we will make furniture account here. This was the first, suppose on 1st April 2025. Mm, So in furniture account, since this is debit, it is debited, it's an asset. We have debit and credit side. So we will write to cash rupees 10,000. In cash account, in the credit side, we will write buy furniture rupees 10,000. Okay. So basically, thus both the accounts, it is reflecting the transaction. Now the word to and buy, note here to and buy. To and buy. It is used in ledger to indicate opposite accounts. So posting ensures classification of transactions account wise. Journal records the transactions date wise. Ledger groups the transactions account wise. So basically, this classification helps in preparing the trial balance later on. Thus, the process flows like this: transaction, transaction occurs, transaction is recorded in journal, the journal entries are posted to ledger, the ledger balances calculated, then trial balance is prepared. So this systematic recording ensures completeness as well as accuracy. Now, everything we are studying now is basically interconnected. First, we studied business transactions, we studied the source documents, then we studied accounting equation, then we studied debit and credit rules. Now we are studying journal as well as ledger. So basically, all these steps are part of one continuous accounting cycle. If any step goes wrong, then the entire accounting system becomes inaccurate. So that is why understanding the basics deeply is extremely important. So at this stage, you should clearly understand what a transaction is, how to identify the accounts involved, how to apply the debit and credit rules, how to record journal entry, how to post into ledger. So once these basics are strong, the rest of accounting, it will become logical as well as simple. Now let us discuss this example we have. Journalize the following transactions of Mrs. Malika Fashion House and post the entries into the ledger. Okay, so first we have June 5th, business started with cash. So we know journal, we record it in a chronological order, that is date wise we'll record. So journal, first of all, we have written name of the enterprise, books of Malika Fashion House. We'll write journal, okay. We have made a table, date, particulars, ledger folio, debit amount and credit amount. So first transaction is business started with cash. Okay, so what is cash? Cash is an asset. Whenever an asset increases, it is debited. Business is starting with cash, so capital is being introduced. Whenever capital increases, it is credited. So cash account debit to capital, 2 lakh here and 2 lakh here. Second entry is June 8th. Opened a bank account with Syndicate Bank. So basically, we are opening a account. So our bank balance will increase. Bank is an asset. Whenever an asset increases, it is debited. So where is the money coming from into the bank? Obviously, we have some cash with us. So we are basically transferring our cash to bank account. So our cash is decreasing. Whenever an asset decreases, it is credited. So the entry would be bank account debit to cash account. We have written the narration, opened a current account with Syndicate Bank, rupees 80,000. Third, we have June 12. goods purchased on credit from Messrs. Gulmohar Fashion House. So purchase, we'll debit it. So Gulmohar House is our creditors. Creditors are liabilities. So whenever liability increases, it is credited. Okay. Next we have rent paid by check. What is rent? We had studied debit all expenses. So rent is an expense, so it is debited, and we are paying by bank. Bank is an asset, so it is decreasing, so it will be credited. Purchase office machines paid by check. Office machines, they are an asset. Whenever asset increases, it is debited. We are paying by check, so bank account is decreasing. Bank is an asset. Whenever an asset decreases, it is credited. Next we have sale of goods on credit to Messrs. Mohit. Okay, so they are basically our debtors. Debtors. We have to get money from them. They are owing to us. So they are basically an asset. So whenever an asset increases, it is debited. Sales, it is our revenue, income, so it is credited. Next we have cash sales. We have excesses cash sales. Cash is coming, asset increasing, so it will be debited. Sales is an income, revenue, it will be credited. Then next we have cash paid to Messrs. Gulmohar Fashion House. So Gulmohar Fashion House, they are our creditors. We are paying them. Cash is decreasing. Next we have received a check from Messrs. Mohit. Mohit, they were our debtors. So we are full and final settlement is being made. Debtors are basically are an asset. When our asset decreases, it is credited. Bank balance is increasing. Bank is an asset. When asset increases, it is debited. Last we have salary paid in cash. Salary is an expense. Debit all expenses, so it is debited. Cash is an asset. When asset decreases, it is credited. We are writing the corresponding narrations we are writing. Now, we are done with the journal portion. Now we will post it into ledger book. Okay. So first of all, whatever accounts are there, like cash account, capital account. So capital account is a liability. So whenever the liability increases, it will be credit. So cash account debit to capital account. Next we have opened a bank account with ICICI. So we can see asset whenever it increases, it will be debited. So bank account debit, or since we can see here whenever asset is decreasing, it is credited. So to cash. Then we have goods purchased for cash. Goods purchase is purchase account will be debited. Cash is decreasing. It's an asset is decreasing, so credited. Paid cartage. Cartage, it will be expenses being incurred. Okay. Debit to cash. Cash is decreasing. Asset is decreasing. To it will be debited. Goods sold on credit to Messrs. Lara India. So goods are sold on credit. So first of all, our sales is being made. Sale is our revenue. So it will be credited. And this is our debtor. They have not paid us cash. So debtors is an asset. Whenever asset increases, it is debited. Then we have goods returned from Lara Limited. So sales. Wait a minute. Okay, this is sales return. Okay, so whenever sales was made, it was credited. When it is return is made, basically this will be debited. So sales return, another separate account will create sales return to Lara India because our debtors are decreasing. Whenever an asset decreases, it is credited. Then we have paid trade expenses. Trade expenses debited, and asset is decreasing, so cash account will be credited. Then we have goods purchased on credit from this Taranam. Okay, so purchase account debit, and this is basically our creditor. So whenever creditor is a liability, so whenever liability is increases, it will be credited. Okay, so after the goods have been returned to Tarannum, then we have stationery. Paid for the stationery, it is stationery account debit is an expense. To cash account asset is decreasing. Then check check paid to Tarannum on account. Check we are paying. So Tarannum is basically our creditor. So whenever creditor liability decreases, it is debited. Our asset is decreasing, bank is decreasing, so it is credited. Then we have paid rent by check. Rent is an expense. Expenses are debited. Asset is decreasing, so bank account credited. Then we have drew cash for personal use. Drawings are basically reduction in capital, so drawings are debited. Cash account asset is decreasing, so it will be debited. Next we have cash sales. Cash sales easy. Cash is increasing, so cash account debit. Sales is our revenue. Sales account credit. Okay. Goods sold to Mrs. Rupak. Rupak traders. So they are our debtors. So Mrs. Rupak debit. So Messrs. Rupak account debit to sales. So after we have recorded these transactions, we have recorded it in journal. So we'll post the same in ledger account. Okay, so what we have to do for that? We have to make these accounts. We have cash account, we have capital account, we have bank account, we have purchase account, then we have cartage, we have our debtors, we have the sales return, trade expense, purchase, discount. We have similarly for all the accounts that are involved, we have to make account. Okay, so like in first entry, cash account to capital, cash is debited, so on the debit side of the ledger we will write to capital. Okay, so here we have written to capital 1,20,000. The corresponding entry in capital we have credited by cash 1,20,000. So like this we have to record all the entries in these accounts. Hello, now let us discuss some questions. First of all, we have voucher is prepared for cash received and paid, cash credit sales, cash or credits purchases, or all of the above. The correct answer is all of the above. So we know that voucher is basically a documentary proof of every transaction, whether it is cash receipt, whether it's cash transactions, cash payment, credit sale, or credit purchases. So therefore, vouchers basically are prepared for all types of transactions. Second question we have is voucher is prepared from documentary evidence, from journal entry, from ledger account, or from all of the above. The answer is voucher is prepared from documentary evidence. Okay, so basically vouchers are prepared on the basis of a source document such as invoice, cash memo, bill, receipt. So basically journal and ledger they are prepared after voucher. There is not the other way around. Next we have how many sides does an account have? It's very easy. We have two sides. We have one debit side, the other one we have credit side. Debit side is the left side, credit side is the right side. And this is the foundation of double entry system. Fourth, we have a purchase of machine for cash should be debited to. The answer is machine account. Okay, we know that machine is an asset. So when an asset increases, it is debited. Cash here is decreasing. Cash is decreasing, cash will be credited. So here the question has asked only for the machine. So whenever machine is increasing, machine what is debited? Machine account is debited. So which of the following is correct? Liability equal to assets plus capital, asset equal to liabilities minus capital, asset equal to asset, capital equal to assets minus liability, or capital equal to assets plus liability. Okay, so this is the basic accounting equation. We had studied that assets equal to liabilities plus capital. So this would be the correct answer. Now let us go through the options. Okay, liability equal to asset plus capital. This is wrong. Asset equal to liability plus capital. No, it is wrong because asset equal to liability plus capital. Capital equal to assets minus liabilities. Okay, so if we go through this equation, if we shift liabilities to left hand side, so asset minus liability is equal to capital. So yes, this is true. Capital equal to assets plus liability. No, this is wrong. Sixth question we have, cash withdrawn by the proprietor should be credited to. It's very easy. Whenever cash is withdrawn, then drawings are debited, and cash is an asset, cash is decreasing, so cash credit. So which account should be credited? The answer is cash account. Seventh question we have is, find the correct statement. Okay, first of all, credit a decrease in asset. Okay, then we have credit the increase in expenses, debit the increase in revenue, credit the increase in capital. Okay, so credit or decrease in asset. We know asset, whenever there's an increase, it is debited. Whenever there's a decrease, it is credited. Okay, so this is true, but it's a partial rule. Second, we have is credit the increase in expenses. We know this is not correct because increase in expenses are debited. Then we have debit the increase in revenue. This is wrong because debit the increase in revenue because increase in revenue is credited. Credit the increase in capital. Yes, this is true. The book in which all the accounts are maintained is called as, we know, it is ledger. Recording transaction journal is called as journalizing. Journalizing is recording transactions in journal, and posting, it refers to transferring to ledger. And casting is basically totaling of the accounts. Hello. So let us go through a quick revision for MCQ like this. Voucher, we know it's a proof of transaction. It is prepared from documentary evidence and it is used for all types of transactions. Then, so voucher, you remember it always comes before journal and ledger. So sequences, transaction, source, document, voucher, then journal, then ledger. Then this accounting equation is our accounting equation. It is our golden formula. Assets equal to liabilities plus capital. So the examiner will try to confuse you by rearranging it. Its rearranged forms are capital equal to assets minus liabilities, and liabilities equal to assets minus capital. So assets are basically what the business owns. Liability plus capital are who business owes. Then we have two sides of account. We have two sides of account. We have the debit side, just the left side, as well as we have the credit side, which is the right side. So account looks like the letter T. Modern rules of debit and credit. This is very important. account type, increase, decrease. Okay, so we have asset, we have expense, we have liability, we have capital, we have revenue. So whenever asset increases, it is debited. Whenever asset decreases, it is credited. Whenever expense increases, it is debited. Whenever expense decreases, it is credited. For liability, an increase is credited and decreases debited. For capital, it is also credited. This is debited. Revenue is increases credited, decreases debited. Okay. Then we have drawings, expense as well as asset. Okay. Hello. Okay, remember this thing. D E A. D is for drawings, E is for expense, A is for assets. Okay, D like the short of dealer. Okay, so DEA, note that whenever these increases, it will be on the debit side. Whenever these decreases, DEA decrease, credit side. Then we have the traditional rules, or we can say the three golden rules of personal account we had discussed. Debit the receiver, credit the giver. Then we had real account. In this we discussed debit what comes in, credit what goes out. Then we had nominal account. In this, debit all expenses and losses, credit all incomes and gains. And if you're confused, then always convert it into the modern rules of asset, liability, expense, etc. Then we know withdrawal by proprietor. It is called as drawings. Owner can withdraw cash. If the owner withdraws cash, then drawings will be debited to cash. Then journal. We know journal is book of original entry. Ledger is book of final entry, and it contains all accounts. Recording in journal, it is called as journalizing. Transferring to ledger is called as posting, and totaling is called as casting. Then we had simple entry, in which there was simple entry. In this we had one debit and one credit. In compound entry, we had one debit, we had multiple credits, or vice versa. Then we had complex transactions, which is the compound entries are involved. Then, as we complete this chapter, so let us take a moment to understand what we have really learned. So, this chapter is not just about journal entries or ledger posting, it's about building the foundation of the entire accounting system. So, we begin by understanding what a business transaction is and why monetary transactions are recorded. We learn the importance of source documents and vouchers, because accounting is based on evidence and not assumptions. Then we move to the accounting equation and saw how every transaction keeps the equation balanced. That equation we know asset equal to liabilities plus capital is the backbone of all the of the double entry accounting. After that, we understood the debit and credit rules, both modern and traditional classification of accounts. We learned how to identify the accounts, apply the correct rule, record the journal entries properly. And we also saw how journal entries are posted into the ledger accounts, how accounts are balanced, and how the accounting process flows step by step. So if you clearly understood this chapter, you will never be able to struggle with journal entries, ledger, trial balance, or final accounts. So everything in accounting is built on these basics. So always remember, strong concepts create strong accountants. So if this detailed explanation helped you understand this chapter clearly, don't forget to like this video, share it with your friends, and subscribe to Ria's classes for more concept based and in-depth accountancy learning. So keep practicing, keep revising, and I'll see you in the next class. Bye bye.